Nice to meet you again. We continue our analysis of value-based management and approaches to company development. And today I'm going to focus your attention on the planning for value creation, and namely for the growth analysis. And we have an agenda which is really big, but that topic consists of several parts. And this first part is focused, as I already told, on the growth analysis. And we are going to cover in that first part only those points that are now marked in brown. So at first, I would like again to show you that there is great difference between the so-called accounting-based model of financial analysis of the company and the finance-based model, even when it comes to the growth analysis for the strategic planning. Then I'm going to switch to the finance-based model, and based on that model, we are going to look at the types of growth and the so-called profit trap. We'll be involving different consultancy companies' approaches and their interesting research results. And then we will look through different toolkit, which is mostly focused on the matrices for benchmarking our plans for the growth for the company development. And finally, our goal is to run some analysis to show, do we have some compact and some interesting metrics or toolkit to measure sustainable value creation, because this is the goal of the company, to get an approach that will permit and will enable company to go through the sustainable value creation processes. And I, of course, would like to talk with you about the so-called integrated model of growth by Boston Consulting Group. This really very interesting approach, which has been created by BCG consultant company many years ago, but they continue researching that area, and that's why it's really interesting approach, because it permits for us just to compare different periods of time and to find very interesting solutions. And of course, we will try to finalize everything that we are going to discuss today in our takeaways, but at that time, for the part number 1, the lessons learned from that integrated model of growth. So let's start our discussion of the growth analysis. And I'm now introducing 2 different approaches. In accounting-based approach, BCG Group, Boston Consulting Group, many years ago, introduced so-called sustainable growth rate. And I will show you in a few moments what does it mean. This sustainable growth rate is based on the financial reporting data, and it requires a few financial ratios computed from the financial reports of the companies. But on opposite, the finance-based approach doesn't deal with the accounting data. When looking at the growth, the finance-based approach, as always, looks through the lens of the risk-return trade-off, and that's why it provides some approach to the quality of growth and types of growth analytics and value creation by the growth strategies. And that's why we will be capable finally to come to the sustainable growth of value creation process. So the sustainable growth rate, as mentioned, it was introduced by BCG consultants. This is by definition the growth rate for the sales revenue of the company when the company follows 2 different assumptions simultaneously. The first set of assumptions says that the operating policy of the company must be constant. So the company must keep the financial proportions, the financial ratios that can describe its operating policy, how the company is producing the product, which products, the technology, the markets, so on and so forth. And the second set of assumptions is about the financing policy. And again, the company should fix the financial leverage or the proportion between the debt and equity capitals it attracts from the market, and how it is going to distribute the net income after tax, whether it's going to pay some dividends or not, and the dividend payout should be also predetermined. So as we see here now, the operating policy could be described according to BCG idea by two financial ratios. The first one is profit margin, based on the net income the company produces. And the second coefficient is asset turnover, which shows, as you pretty well know from the previous courses, how many times the assets of the company can produce sales revenue within the year. So the higher the coefficient asset turnover, the more productive is the company. The same is true for the profit margin financial ratio. The higher the ratio, the more profitable is this particular year for the company. So by definition, for sustainable growth rate analysis, we need to keep them untouched. We need to keep them constant, fixed as they were in the previous year. For the financing policy, we see here the financial leverage coefficient, which is now presented by very original coefficient, when in the nominator we will not have the debt capital as always, but it's suggested to apply total assets, which is total capital attracted to the company, and denominator is telling the story about the equity that the company has. And it should be multiplied by the retention rate, which is based on the idea that you already fix your dividend payout coefficient. And then when you subtract your dividend payout coefficient, which is dividends to net income, of course, then you will describe how much profits you are going to reinvest into your projects. So all four coefficients must be fixed. And what does it mean for us if we just multiply all these four coefficients? We should get that sustainable growth rate. What if our sustainable growth rate, which is just computed with these four financial ratios, is going to be a little bit lower or really much lower than our expected growth rate that we would like to follow in our strategy for the growth? Almost all the corporate strategies are telling some story about the company growth ambitions. So what if our ambitions should be much higher than the coefficient we've got multiplying these four financial ratios? Then it means that if you want to get that much higher, more ambitious growth rate, then you need to break those assumptions. You need to introduce a new operating policy, which will mean that you need new organic investment projects internally developed in the business, or you will switch to the mergers and acquisitions because you need now to buy some other companies and change your investing policy. You are going to produce new products, you are going to go to the new markets, and maybe you are going to acquire some companies. Which types of companies it's worth acquiring at this particular point of your analysis? Let's look through the financing policy. If you want to grow much higher than sustainable growth rate, then it means that you do not produce, you do not generate enough cash flows internally, and you cannot have all the financing funds you need for that type of the growth. So that's why I'm writing here that slide that would be the situation of financing deficit for the company. And the changes that companies should introduce in the financing policy, trying to reach this more ambitious growth rate than sustainable growth rate itself, will mean that the company need new debt or new equity or both of them to be attracted in the upcoming period, and the company will change payout policies. So let's go back now to the first type of the decisions, which are an investment decision. If the company wants to pursue also inorganic investment, it means it's going to buy some other businesses. It's worth buying the companies which may be called cash cows, which have solid free cash flows, positive of course, and then buying those companies, you will get enough cash to pursue all other investing projects that you want to introduce in your business. So to summarize that particular slide, in case expected rate is much higher than sustainable growth rate, it says for us that the company doesn't have enough cash flows to get that expected rate. So that's why there should be lots of different changes in financing policies as well as in investing policies of the business. What if the situation is just opposite? What if your ambitions are not so huge and your expected or forecasted growth rate is really lower than the sustainable growth rate? Then again, you need to break all the assumptions because by definition, sustainable growth rate, it's the rate of revenue growth in case you do not introduce any changes in operating and financing policies. But if you do not want to pursue sustainable growth rate and you have much lower ambitions, then again, you need to change something in your operations, and maybe you need to acquire now some other types of companies which have some potential for growth, which have really high growth opportunities because your company, you do not have this high ambitions because maybe you do not have high growth opportunities at all. And in this situation, the inequation that we can see here, sustainable growth rate is higher than expected or forecasted growth rate for that particular business, the company will have an excess of funds, and that's why it's capable to acquire the growing firms outside. And it's capable now to pay large dividends or be involved in the large share repurchases. So let's now summarize what we've got, our preliminary conclusions. Accounting-based approach, which underlies sustainable growth rate computations and analysis, provide us with the so-called implied growth rate, which says that you may go through that particular type of growth following your implied or sustainable growth rate because you will just have enough funds to pursue this particular dynamics of your growth. And that means that you will have some preliminary analysis of your threshold growth rate for your strategic plans. On the other side of a coin, you may apply, as BCG consultants made, that particular approach not only for one company, but just for the overall industry. And again, the same would be true if your expected or forecasted rates for the overall industry higher than sustainable growth rate, then it means that there are too many growth opportunities and the competition will be much higher for getting them, for catching up those growth opportunities. If your forecasted revenue growth rate for the overall industry is lower than the sustainable growth rate, then vice versa, the competition is not so much. There is some excess amount of cash flows within the industry. So again, there would be some very big changes in the industry at all because now you need to restructure some businesses. Now you need to spend that cash somehow to use it, this vast amount of cash. And maybe you will be buying growing businesses. So the competition for these growing businesses, for acquisition of those types when you are trying to buy the growing companies, will become really sharp, will become really tough. And it will also mean that competing on that basis for these growing companies, you're going to pay maybe much higher premiums for these targets, which are capable to provide you with these growth opportunities. And those premiums paid for these targets in mergers and acquisitions deals will become really unreasonably high, maybe in that particular situation, as compared to the intrinsic or fundamental values of those growing targets. On the other side of the coin, our conclusions say that finance-based model will give you some other advices and some other solutions. And we will switch in a few minutes to the finance-based model for growth analysis, and we will talk about the quality of growth per se.